watching Stockwatch with me, Julieta Televi, and join me to take your stock-related questions this evening are David Shapiro from Sasfin Securities and Wayne McCurrie from F&B Wealth and Investments. If you'd like to send questions, please SMS 41392 or email stockwatch@bdtv.co.za. Wayne, David, good evening to you both. Wayne, if I may start with you tonight. It's not a great finish for the JSE today, and a few shares came under pressure. I'm not sure if it was a combination of some companies going ex-dividend and then some not so great results. I mean, and here I'm referring specifically to something like Woolworths, which came off about 5%.
The Woolworths one I found a bit odd because I didn't read anything different there than what they had already disclosed in their trading update. So I just didn't understand why it got so slammed. I mean, maybe I missed something. Maybe David can add something there, but I didn't see anything in the actual trading update that was different to in the actual results. It was different to the trading updates. I was quite surprised it got hit so hard because I thought all the bad news was out there. So, you know, I read their outlook statement. The outlook statement was the normal story. You know, things are bad in South Africa and port challenges and logistic challenges and electricity challenges and personal disposable income challenges. But we read that more or less the same statement in every South African company.
I mean, David, do you think maybe it had to do with the negativity that they are being engulfed by in Australia? Because that's quite interesting. You know, they talked about how consumer confidence in Australia, New Zealand, specifically Australia, is at its weakest since the global financial crisis, which is really quite interesting. And
it could be.
I mean, the margins for the country road business essentially, well, almost halved. I mean, they were 8.5% compared to 15% this time last year. That's a big whack, and maybe we just weren't expecting that. We just think everything is bad in South Africa and everywhere else it's rosy.
Yes. Look, they've got rid of David Jones, I mean, which is a big weight off their shoulders, but it is disappointing to see what's happening in Australia. The one point that I picked up, and I don't know whether this is just seasonal, was that their debt has gone up to 4 billion from about 575 a few months ago. Now, I don't know whether that's important. We saw a very similar story, I think, with Pick n Pay and with other retailers. So it might just be seasonal, but I don't know whether that scared anybody, you know, which always suggests that when your working capital's under pressure, stock building up, and there are other issues that you can't recover. But I'm with Wayne. You know, when I read this, there was nothing there that surprised me initially. And I was a bit surprised to see them, you know, down as much as they were today.
I mean, actually,
you know, we know the food side. We know that they've had problems clearing customs or clearing the ports and that, and they might have missed out on some of the fashion side and that. But you know, overall, the food side was still very vibrant and doing well. So I can't add.
You know, the operating profit margin in the food business is 7%. That's better than Shoprite. That really is. It's an astounding profit
have you ever
margin.
shopped at Woolworths?
Yes. You have to sacrifice a limb and maybe a few internal organs when you
Try
get to
buy
the
a mango
till.
there. You got to mortgage your house to buy a mango. You know, like anyway.
Well, actually, a viewer says Woolies pain, Sasol pain, MTN pain, First Rand pain. What a day! It does feel like that at the moment. One has this sort of sense of a bit of desperation on the market that we're just not going anywhere other than down. I mean, Wayne, how do you work, you know, get yourself through this kind of environment?
Well, look, I've learned over many decades, and Shapiro a couple more decades than me. These things happen in the markets, you know, when there's excess positivity or excess negativity around. The shares do strange things and you shake your head and look at them. But I also firmly believe that over time, the market's extremely accurate in pricing earnings, in pricing shares essentially. So there are massive variations around, let's call it a normalized level or a fair value level. And the market does in fact return to that. So the resource shares, I get that. Maybe they've been pushed down too much, but we're in a down cycle, so they should be weak. But I mean, you saw Standard Bank's trading update today. I mean, earnings are going to be healthy there, and yet the banks are going nowhere, and First Rand's going down. But I mean, these things do happen. Then the mood will change one day. You know, what triggers it? Maybe maybe falling interest rates, whatever triggers it, and then the market goes up again. You know, that's just unfortunately the way the market works. But I suppose the really unfortunate thing is that we human, is that, you know, you live this day to day to day, and then you start looking around for reasons, and then you start thinking, no, this time around it's different, and I'm just getting slaughtered on these shares, and I can't take the pain anymore. And then you sort of sell out at the bottom, and then you go for the go-go shares that are just going up and up and up. And you want good news, you want to feel happy, so you buy these shares, and you end up selling one lot of shares at the bottom and buying the other lot of shares at the top.
Yeah, I know, and we never learn.
You don't have to do anything in this market, Juliet. You know, you don't have to do something every day. And I think that's what Wayne is alluding to. You live through a day, but, you know, we live through it every day. And you're right. You know, when we go through the results, whether it's Woolies, AECI, CAP, whatever it is, they poor results, and they're reflecting what's happening in the economy. There's nothing you can do about it until the economy change. And that will come when rates start to come down and China starts to stimulate and things happen. But I mean, if it looks, you know, if it's raining outside, you don't have to go out there in a pair of shorts and try play in the, you know, play in the garden. Just stay inside.
I mean, you spoke about MTN earlier on. I mean, MTN, we know what's happening there. The Nigerian currency has collapsed like you cannot believe. I mean, you can't believe the extent of that collapse. And of course, that does affect MTN. So, you know, unless you believe that the Nigerian currency all of a sudden is going to stage a comeback, you know, MTN probably won't be going up soon. But a lot of the other companies, it's just cyclicality in the mining shares. And on a lot of other shares, maybe, you know, FirstRand, it's just the market sentiment is against you. I mean, you can understand Woolies being negative because they've got serious problems. But a lot of it is just people are just negative, and the market's negative. Everyone's negative about South Africa. You can see it in the rand. And, you know, these things can change because, I mean, how many times, well, let's think about it. 1, 2, 4, 5, 7 times in the last 20 years, South Africa was going to the dogs, and it's never going to do anything again, and everything is completely and utterly blown out. And 3 years later, after those negative points, things look a lot better. The rand strengthened a lot. We all feel a lot happier. So, you know, being negative in South Africa shouldn't be a new feeling for people.
Yeah.
It's not the first time it's happened. It's not the last time. But it can recover.
Yeah, it does feel particularly intense. And I think maybe we're all, unless you live somewhere in the Western Cape, we're all looking at the destruction of our cities on a daily basis. And I think this must feed into the general mood. But just a viewer talks about FirstRand, and he says, hi to the A-team. He says, on a lighter note, in quite depressing times on our stock exchange, the following. 2 years ago, FirstRand made a brief high of around 79 Rand at the time of the special dividend. It is today trading at 64 Rand and 15 cents. In view of FirstRand publishing its financial results tomorrow, would your team be of the opinion that there is a bigger chance of a return to higher ground, or should I lock my keyboard away, irrespective of the results? Thanks, as usual, for the program. I mean, David, going to your point about staying indoors and not getting cold and soaked in the torrent outside, would you just maybe actually...
It's bumbling along. You know, just FirstRand is just kind of bumbling sideways, making lows and then a high, then a low, then a high, and so on. And you can't force it. And I think it's exactly what Wayne said. The results are good. You know, they're not doing anything stupid. They're not doing anything ridiculous, being forced to lend money. So I think you just got to hold on and just let it find its level. You know, it will come. But for the meantime, it's not letting you down. You know, it's not, the results are good, management's good, and paying you a fairly decent dividend. So hang in there, but don't expect this to rush. You know, don't expect the results to cause a massive increase so that they're going to get to those, you know, those past highs. I think most companies are just kind of bumbling along, and you just got to go with it. The one thing I must say is that overseas things are okay. You know, if you look at the US markets, they're doing fine. Everybody's trying to talk them down. They're not going down. You know, even Europe is holding its own. And for me, that's a good sign to follow.
But, you know, here too, I mean, if I look at my small share portfolio of discretionary stocks, and there's only about 5 of them, and Standard Bank, I bought it last year. It's up 26% over the year. That's a really good return. Grindrod, I'm up about 67% since I bought it.
Yeah.
I feel really happy about, and in the, maybe to, Wayne's points, in the tide of general woe, you forget about the bright spots on your portfolio because you're just swamped by all the negative news. But actually, there are bright spots, so don't forget that.
Yeah. Now, look, I mean, you're talking about First National Bank and that. I can remember one of the senior executives at First National Bank. This was years and years ago, donkeys years ago. In fact, he came, we were having a chat, and he said to me, "We are owed a bull market."
I like that.
Yeah.
And I think maybe we owed a bull market here in the next 2 or 3 years in South Africa.
I certainly
mean, our return on our all share ex-dividend is about 32% over 5 years. So it's not negative, but yeah, that's in rands.
Then just sticking with the financial services companies, a viewer sends a question on the panel's view on Momentum and Old Mutual. I sense a distinct lack of excitement.
You're trying to sell financial services in an economy that's barely growing. This is discretionary spend. You knock on doors and you try to sell them policies or you try to sell them products. It's not going to be easy. Again, they haven't really let us down. There are no major claims on any of those companies. So they're okay. Wayne knows them a lot better. He's much closer associated to them. But I think you can't expect them to blow out in this kind of environment, where things are under pressure, where consumers are under pressure. So you find, I don't know what the lapse rate is, Wayne. I don't know in these kind of
no, it's not bad. I mean, the underlying results of the life insurers is not bad. I mean, there's a few serious structural problems. One is it's essentially an overtraded market. Essentially, it's overtraded. There's lots and lots of players in this market.
You need economic growth.
Once again, we need a bull market because essentially these are geared investment trusts.
So a viewer sent this question on Monday, and he says, I asked this question on Monday, but I'd like to get David and Wayne's view. All-weather asset managers are asking Treasury to reduce the Regulation 28 foreign allowances, arguing that it'll benefit South Africa, the JSE, and the JSE, the poor asset managers. But what about the interests of their primary stakeholders, their clients? Wayne, sticking with you, I completely understand where all-weather is coming from, given the sort of morgue-like state that we are enduring on the JSE at the moment. But ultimately, it is the client that counts, not one's own business, right?
Yes. I mean, now look, effectively, and I know there's all the prudential guidelines and all of these things, but effectively, you can get a lot of money overseas now, still within the regulations. There's lots. You might not physically have the assets offshore. Your assets might still be denominated in rands, but the biggest driver will be overseas earnings or foreign currency. I mean, there's so many. You could effectively get virtually 100% of your equity offshore and still be within the guidelines. Well, not offshore, but with offshore exposure.
Do you have some sympathy, though, to the point, clearly Enoch Godongwana himself feels that it was a bit of a mistake to up the prudential limits to, what, 45%? David, or do you think actually no? That's if you create a good environment and that capital wants to come to you, capital will come, and that's actually the issue.
I absolutely agree with that. I battle to put a decent portfolio together in South Africa. It's very, very difficult to find the stocks, and you've been hearing what we've been talking about in the first part. It's not easy to find places to park that money. Yes, you can park it in bonds, giving 10% long bonds or wherever they are. Property is not giving you any decent returns in that. So at the end of the day, these Regulation 28 companies, these are pension funds. These are future pensions of people, that this is their earnings, or call it their deferred earnings. You can't mess around with that. You've got to ensure that they can retire comfortably, and asset managers have got to do everything in their power to make sure of that they retain their purchasing power. So I'm very loath to fiddle around with the data and so on. I think you've got to give, you've got to open it up and allow managers to go where they can get the best returns. Yes, there is a liability. You've got liabilities in South Africa, and you've got funding, and you don't want to go offshore in case things do turn the other way. But on the other hand, what Wayne says is, our market is BHP, AB InBev, Richemont, Process, British American Tobacco, Glencore, Naspers. These are all offshore businesses. These are all the top companies on our market.
But I mean, even though you might not be able to stock pick, you can buy any overseas index you want to listed on the local stock market that doesn't qualify as global at all. But I'll just say one thing, and you don't often get the chance to say this. When it comes to foreign exchange and loosening up the ability to get overseas exposure, you can't actually fault the government. I mean, you think of where we were in the early 90s. You had to smuggle money overseas illegally. So we can't chastise the government too much about the non-relaxation of foreign exchange control. I mean, except for the super rich like Shapiro, ordinary Joe can get literally as much money overseas as what they want to.
Yeah, it's just one hell of a process. The paperwork is what kills you. Yes, this paperwork, I mean, unfortunately, it will be a feature of your adult life irrespective. Talking about one of those offshore-based stocks, there's a question on Mondi, and he says, I'm a long-suffering Mondi shareholder who has yielded a huge 2% gain for something like 10 years, excluding dividends. Is it time to cut this loose? Or is it a cue to the rest of the market that this is the biggest buy signal ever? What should I replace it with? It must be a rand hedge with decent dividend and growth prospects. PS, no resources.
You often get this, just as a comment, you often get this no resources story at the bottom of the market. I can remember managing money where clients gave you money to manage at the bottom of the market in 2015, and they specified no resources, and the shares were up 300% in the next 2 years. But Mondi is disappointing, I will be honest. I thought this was in the sweet spot for onlining and packaging and specialty packaging, and I thought this company is going to do extremely well. It hasn't, and yet surprisingly enough, it's not cheap. It's not a four price earnings ratio or a 12 dividend yield. It doesn't look cheap.
It's well run. It's a well run business, but they haven't got pricing. It's too competitive. They've got no, what's the word, definitive edge. There's no competitive edge that they have. They have to take capacity out. They're constantly trying to get prices up. They face higher costs in, input costs. They're reliant on the economies, on the global economies. If things slow down, so packaging slows down. So it's just gone nowhere. So I can understand the frustrations. I think sometimes you've got to say, why are we still there?
Yeah.
You've got to actually question, why are we there?
Of course, it becomes a more difficult conversation with oneself when you've been there for 10 years and you think, if I sell out now, am I ringing the bottom of the stock market? Because then you think, it's going to go up 30% from the moment I sell it.
I mean, you can look at the last results. The last results in December, everything halved.
Against expectations. No one expected that to happen. So it has been, we got it out of Anglos. It was unbundled out of Anglos. And then we also had impact over here. There was a whole lot of issues taking place, but it's just gone nowhere. I don't know. Sometimes I'm starting to revisit a lot of stocks that been holding that just seem to do nothing.
Oh, okay. So
why am I holding them?
Okay, so if you say to yourself, actually, I'm really fed up with this, and even if I am calling the bottom of the market, what would you replace it with if Mondi were in your portfolio? I suppose, which is a bit of a tricky question because we don't really know what else the viewer has in their portfolio.
I think you can replace it with one of those ETFs that Wayne was talking about. I've got there's a lot happening in global markets. Just had a wonderful presentation from UBS on the European Magnificent Seven, and
the granolas, they're called.
Whatever they are, and you suddenly realize, hold on, these companies are good. It's not only the US tech companies. There's the Ferraris, there's the LVMHs and L'Oreals and Novo Nordisk. So I'm saying you can search for good businesses. If you put the two together, the two Magnificent Sevens, well, you place for life, well, not really. But
going back to Wayne's point, and a question actually, a viewer says, the Magnificent Seven just seem to continue to go up and up. Is this a bubble just waiting to pop? Or are the earnings unraveling the elevated PE ratios? Stay invested or start reducing positions? Wayne, let me get your view on this.
Yeah, look, I mean, this is the ultimate question. If we knew the true answer to this, we wouldn't be telling anyone. But two things I think are important. The only real danger with these companies is the share price. It's not the company. This is so different to the dot-com bubble. These are proper, massive companies with huge balance sheets and big earnings and big cash flows and extremely well established, not really threatened by too many other players in the market. So the only only thing that can go wrong here is maybe the share price is elevated. Now, we saw that 2 years ago, or a year ago, whenever it was, and the shares came down 30, 40%, but the earnings are still there. So maybe that's the worst that can happen, is that the share prices may come off. But should that occur, you would just totally fill up your socks there. So it's not a bubble. And I'm not saying the share prices can't fall, but it's not the true classic definition of a bubble where the companies just disappear.
Yeah, you've got Bitcoins at 61,000. Try and fathom that out. So if you want some puzzles or conundrums, try and work that one. But I'm with Wayne because I like to look at earnings and I like to look at the underlying businesses, not necessarily the share price. And you don't get that feeling that things are going to fall in a heap, especially, I don't think management's going to lie to you. I don't think, especially the managers of those kind of companies. We know them, we've tested them, we've seen them. And overall, you can put together a really good selection of top quality global companies. I think that's locally, it's not that easy. Locally, it's not that easy to match those kind of businesses. But I mean, on the foreign side, yes. And you don't have to be clever. You really don't have to be clever and start digging for companies that are going to try and compete with NVIDIA. So I think why I bring this up, I think it's a very stabilizing force for global markets. And I think we'll get we'll get some kind of lift from what's happening overseas.
Okay. So that
we're still waiting for Powell to blink, but anyway.
So in the last minute between the two of you, what are your stock picks this evening? Wayne, what are you gunning for?
I'm going for eBay. They came up with results. They beat the results. They upped their dividend by twice what their earnings growth is, and they've announced a 2 billion share buyback program. And if you look at the price chart, this share is not at its record high by a long way. It's actually come off over the last year or two. So yeah, it's still competitive. It's still there. The earnings show it. It was a good set of results, and coupled, as I said, with the nice dividend and share buyback program.
Up 8.6% today. David, how about you?
You have to look at Advotech. Now, every day I look at it and I see a new high. And over the last 5 years, this company is up over 100%. You're 15% per annum you've made on Advotech. We haven't heralded here. We haven't spoken about it or got too carried away. I think in the last 2 years, it's up maybe a 70%. But it's exactly what Wayne was saying. Yeah, there are businesses there, that just seem to be doing well and pick those up. So, if you look at it, it's from bottom left to the top right.
I know, that's a sensational chart. Little old Advotech.
So that's a Shapiro. That's a Shapiro chart, that one.
Yeah.
Not too late to buy, David.
First rand's going sideways, this one's going up there. And it doesn't falter. Yeah. It just, every day, it seems to be making new highs. So anyway, I don't know what's happening there, but does seem to be a pretty good company, and people are obviously spending on education.
Yeah. Okay, gents, we leave it there. Thanks very much for joining us this evening. David Shapiro is from Sasfin Securities. Wayne McCurrie is from FNB Wealth and Investments. And up next, The Close. Stay with us.